Portfolio Builder members, today's trade alert is a winner, and we're covering Friday's position for a nice profit on the covered call and issuing another defensive trade, the 286 strike. So buy to close Friday's trade, you'll have to pay $1.15 approximately, but remember we did collect in the previous week trade Friday at $1.69, so we made a 31% profit on the covered call, and so some of that profit is offset from the underlying ETF going down a little bit from Friday, but overall we're making that $50 three times a week, which ends up being about a 30% return over the course of a year. If we're playing it defensive, of course, if we play it offensively, then suddenly we can get closer to a 50 to 60% return. So most likely somewhere in the middle is where we'll end up. And we actually had more profits this morning on the covered call as it initially had started to crash. Right now it's rebounding slightly. Doesn't really make a big difference to us because our strategy is more like purchasing a nice apartment in New York City and then using something like the Airbnb app to rent it out every 2 days. Difference is we don't have to renovate the hotel room. We just spend 2 minutes doing the covered call every Monday, Wednesday, Friday, right at 11 Eastern, followed by a live webinar. Here's a look at the two trades on a trade ticket. You can see buy to close 17. So in this model portfolio, we're starting with $500,000 and we have 1,700 shares of the SPY. You can follow this program with just 100 shares of the SPY. And remember, on Fridays we trade the TBT, which is what we call the poor man's income strategy. So if you only have about $4,000, you can follow that program every Friday. And today's trade again is to buy to close the April 8th. That's expiring today. We're taking a profit on the covered call. And on the new trade, we're selling to open the April 10th 286. And if we look at the option volume today, it's a pretty good mix, but I would say it's a little bit heavier on the put option. We can see 17,000 put options being sold at 286 today. So we chose the 286 strike. The profit baked into the cake, if we're wrong on this, is closer to $35, which is less than the 50. So finally, the market's starting to agree with our defensive stance. We've been a bit early to the game on writing these defensive covered calls. But again, that's our goal. We want to protect our capital at all costs and not be greedy. And even while we're doing these small profits in the defensive mode, it still adds up to potentially a 30% annualized return. So today's trade, if we're wrong and the market goes higher, we'll make $35 per contract approximately. But if we're right and the market trades between 288 and 286 come Wednesday, we will make a bigger profit, while everyone else will be starting to get scared that this monster rally perhaps is running out of steam. And if you think this is a natural stock market, you know, the V-shaped recovery, Ken Fisher was touting that. Of course, he's a billionaire money manager, and their strategy is just to get everybody to pile in, buy and hold forever. And so of course he's going to be bullish. But the real purchaser of this recovery was not hedge funds, and it wasn't retail. So not many people enjoyed this. For those folks sitting on 401ks, you know, they watched their profits collapse from October to December and then just rally right back to where they were in April. So buy and hold investors are back to even. And now the big question is, what's going to fuel this bull market from here? So I believe that we will see some profit taking in April. The big parity funds that leverage a bond stock portfolio had an abnormal return this year, the best in something like 50 years for those strategies, as yields have dropped as stocks have gone higher, which is totally unnatural. And so my expectations is that the yields will come up and that the stocks will come down. So I think they're both wrong. I think the Treasuries got too cheap too quickly, and that Stock markets went up too fast, too ferociously. And the only person really buying this most likely is the Bank of Japan, who likes to buy ETFs. And they have added something like $250 billion to their balance sheet so far this year. So that's a ton of money. And it's just zombie money. It's walking around with no intent to make a profit, really just trying to help stabilize these different global economies. And they have so much money in the stock market, they really can't afford for it to go too far down. So that's kind of our outlook for April right now. Finally, the option volume is starting to agree with us. As I've noted, every time I bet against the market, it's typically made us less money than the market made. So we were playing it safe. We did okay. Probably a lot of people just completely missed out on this rally. But we've been precautious ever since the bond market and stock market became so against their normal correlation. So I'm looking for a reversion back to what's more normal, and we'll see if it starts to pan out. So that's the trade alert for today. Hope you can make it on our webinar. I have a good presentation with some more information not covered in this video. And just for those of you figuring out how to use the software, step 1, place your deposit in the blue area, whichever amount of capital you want. Step 2, if you want to trade the TVT and the SPY, add a little percentage to this, like 10% perhaps, and then decrease that to 80, or if you just want to copy what I'm doing, leave it alone. It comes with this as the default. You put your stock trades down here. Positive is a buy, negative is a sell. It automatically calculates up to here to tell you how much shares you should be purchasing at any given time. We only buy lots of 100, so we can protect ourselves with covered calls. We keep track of the open positions in the open option writing area, and we close our positions down here. Now, for those of you who think these mean we lost money, in covered calls it's actually the opposite. If we have a 100% gain on the covered call, that's when you should wonder what happened to the underlying asset, because if that went down in a greater value than the cash we collected, like for example on these two trades, you may have not actually made money during that period. So when we have a smaller return than 100% or a negative return, that's actually better in general for a covered call strategy. So just trying to go up and down this covered call P&L, very misleading. The 100% gains typically mean the underlying asset went below the strike price and plus the amount of premium we collected, so that we were able to offset the losses on any volatility on the SPY. But really, the profits come in two ways. One, the underlying asset goes up in value potentially, plus we earn money on the covered call. Now in a defensive covered call, we're actually going to do better if it goes flat or slightly down. So if the market goes up here, we'll make the least money possible. But if it goes flat or down between 286, we can generate an even bigger profit from the covered call. Okay, that's it. See you guys on the webinar, I hope. And if not, look for a new Trade Alert Wednesday at 11 Eastern for this program. Tomorrow's our high yield covered call program. This is a more expensive product and it takes more capital to put to work, but it does dramatically increase the income you can generate from the covered call. So thanks for your time and look for a new video tomorrow.